everybody. Welcome to a class here in Partnership Realty. My name is Deicy and my coworker Kaherine Alvarez.
Thank you.
Thank you. Thank you for coming, and whoever's watching us online and the ones that came here. I wanted to introduce my partner here, Kaherine. We know each other for about
7 or 8 years.
7 or 8
We've been working together in mortgages for about 8 years, and Deicy has always been supporting me. We support each other in our different strengths, and that's why we created this PowerPoint today, because we want to give you guys more options to get more buyers, because we know that FHA and conventional is not the only outreach here, and we want to get more clientele than just that. So we're here today to teach you guys a little bit more of different programs that we have.
We'll go over a little bit details. We're not going to be going a lot of, we'll go over like in general, but we're not going to go into every detail. Exactly. We'll do that next with another coworker of ours, which is Diana. So here's as the program, and Kaherine already, thank you for letting us know what the class is going to be. So it's going to be talking about different products. So we're talking about QM products, the standard ones, and then non-QM, depending on the client. So this Cash Plus, maybe you guys have heard of it or not yet. It's a type of product that is very new, very, very new, and it's expanding to our county, Palm Beach County, Broward, and Miami as well. So what this program does is actually helping our buyers. Remember, the market right now is seller's market. It's not buyer's market right now. So sometimes we come across with a property that our buyer's interested on, and the seller had many, they receive many offers, let's say 20 offers, 15 offers on in just one single property. Well, not everybody has that amount to be able to pay for the house up front, right? So what this program does is it's actually putting like an addendum, or like it's like an addendum to the sales contract or sales agreement, saying, hey seller, in case that, let's say, the transaction falls through, we can actually buy the house in cash for the buyer. So that actually is like enforcing or helping our buyers who is doing financing to be able to get the house under contract, which is huge, 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 huge in this market. There's actually, the program has different things, and one of the things that the program actually will require is to actually get like a second deposit. So generally speaking, when you do a contract, you know, you have to put around 1% of the sales price as the earnest money deposit. If the buyer decides to do what's Cash Plus, which is actually securing that contract and being able to get it accepted by the seller, by the seller saying, hey, in case that this buyer is not able to secure financing, then we're gonna be able to close regardless, because this program will buy it, and then in the later transaction, then we'll continue with the financing where the buyer can actually put the house under their name. So it is very, very nice. But now there's going to be the second deposit, which I mentioned before, which is about 2.5 of the sales price, which is the second deposit that this program requires. I don't know if you want to add something regarding that.
Yeah, I think in simpler terms, what she's trying to say is that this program makes it so if the person cannot finance the property and financing falls through, this company, if you decide to use it, will pay cash for the property up front and rent it out to the buyer for 6, 7, 8 months, depending on the situation. They will rent it to the buyer, so the cash, it's kind of like the cash offers there. In case your financing does not go through, the company will pay cash. So what happens is, usually if they are able to close financing properly, then they only have to pay 1% of the sales price to use that program, to have that security behind them. If they do end up using the Cash Plus and have to rent the property for 6 months, then they pay 2 to 2.75%. It just depends on the credit, the area, the different things. It depends on different things. But
okay, and then now talking about what you just mentioned about renting the property, one of the things is like, yes, let's say the buyer decides that they're not able to close on time, so Riven, the program or the company is actually going to purchase it. The buyer is actually going to know exactly how much they will have to pay in rent up front. So it's not going to be like a surprise at the end. It's like, oh no, I'm not going to be able to pay that rent. They're going to be able to know exactly. So that's also very, very important, right?
Yes. Like Ribbon will provide you a pre-approval up front and let you know what the rent payment will be so that you won't be surprised. Your client won't be bombarded with like a really expensive payment. It will be like at value. They have their own appraisers that set the value, and everything is very fair. You know, there's nothing going on there. It's just not in Palm Beach County yet. They're doing it in North Florida, and then they're expanding down here. When they see that it's working, they're gonna push it all down here to Miami, Palm Beach. Cash Plus, the company is called Ribbon. So actually realtors have access to Ribbon as well. We both have access, and we're able to seek pre-approvals from their system within. When will it expand? Hopefully this year. We're not sure.
Like before December, maybe?
I think so, just because they have been pushing it on us. You know, they're like, this is going to be such a great program. You should keep pushing it out. Let realtors know. So far, it's only in the north, but they're planning on expanding it down here. So that's why we're trying to give you guys a head start, because it will help. And as
it's huge.
Sorry to keep interrupting.
That's okay.
So many questions. That 2.75%, is that an upfront fee, or is that broken down and tacked on to that 6 months?
So, kind of how she mentioned, it's like an escrow payment. So you put it up front along with the escrow payment. So they charge 2% to 2.75 depending on the case.
Plus that 1%?
If they do not end up using the program, then they receive a credit back, only paying the 1% at closing.
Okay.
And that's if they choose to use this program as a security for themselves.
Yeah.
So not everyone has to use it, obviously. It's for people that want it.
Gotcha. And how do they calculate the rent? Is it just current market value, or
Yes.
what that would be?
Yeah, it's all very fair. They have their own appraisers in-house that do everything to make sure that the payments are equal to what's around it and stuff like that. They wouldn't. That's the reason that they have us pushing it, is because it's such a good program. It's fair. It's very fair, and it keeps people competitive with cash buyers.
And then basically in 6 months they can get their act together and buy the house.
Exactly. It gives them time to.
Can they keep renting after that? Who knows?
Yeah.
That'll be another decision.
Yes.
1% is non-refundable, and then the 2.5% is refundable through an escrow.
Yes.
Gotcha. But
If they do
rent,
use the
they
6
the
months,
3.5%.
exactly. The 6 months I do not think is included in the fee. It's like a separate thing. So 2.75 would be the max that they charge you to use the program. So in reality, it's not so much a buyer program, it's a seller program. So sellers are able to.
Yeah, it's
Get the money.
Exactly. It secures the seller to have the funds, because it's a cash market right now. So many people are using cash, that this is how they secure their offers, you know?
and we can still do the closing afterwards for the buyer. So let's say later on the buyer is unable to secure financing, then Riven is gonna keep that house under their name, and then they'll decide what they're gonna do with that property, if they're gonna resell it.
And if the buyer decides to not go through for some reason, the seller still has Ribbon who will buy the property. As long as all the inspections come back clear, they still are gonna have a buyer. Even if it's not that buyer, it will be a cash offer. So that's why it's beneficial for sellers.
Another very good thing to mention is that let's say we do have to do two closing, which is the first one will be under Riven, who is going to be purchasing, and then later on our buyer, the buyer is only responsible for their closing costs. They're not going to be paying double closing costs.
Correct. Yeah.
Okay.
It will not be two closings in one.
Yeah, and then we'll let you guys know a little bit more about in details when it comes
When it
to this,
expands here.
to
Hopefully
this
soon.
area. Okay, so the next one is another program that we offer, which is Fast Track. Maybe you guys know from previous presentations on what this program, and maybe you don't, maybe it's a new realtor and this is the first time joining us, and we'll go over a little bit on details of what Fast Track involves. So Fast Track is actually getting an approval from our underwriter directly. So what actually helps our buyers, and not just the buyer, but also the seller, is to making sure that that they have a approval from a licensed underwriter where it tells the seller or the agents itself that our client, whoever is purchasing or trying to purchase the property, they do qualify for a mortgage. Because of course, as you know, lenders, investors are gonna be looking at credit reports. If they do have sufficient income to pay their current debts, plus the housing that they're gonna be getting, or the proposed payment. And then also, not just that, but they do have the funds to purchase, because they might have the income, but they maybe not have the assets to purchase. So everything is gonna be reviewed by our underwriters, and they're gonna be making sure that this buyer, whoever is gonna be putting an offer on a house, it's actually approved. So the only things outstanding will be that house, will be the title documents, and it will be the appraisal and the insurance. So with this program, we're gonna be able not to do a closing in 30 days, which is usually what standard closing date will take, or the transaction, but we can do it 21 days. And that's just because getting an appraisal done, it does take time. The appraiser has to do a lot of things. They have to go in and schedule, they have to first approve the order, and then they have to call the listing agent, making sure they get in communication, put a date, and then gather all different comps around the communities to be able to come up with that value. So that's the reason why it does take about 21 days, mainly because of that.
Yes. So I would say Fast Track is kind of like, right now, the current market, the regular standard for us to do is to pre-approve a client. So we take a look at their documents and we say, yes, you qualify for this amount. But in Fast Track, we take the client and we submit it to underwriting with no property address, and it gets conditions, and we clear them all before the client is pre-approved. So they're no longer pre-approved, they're approved. It's a certified approval that the underwriter has reviewed the file, has already cleared the employment, the deposits, the liabilities, the credit, and it certifies that the client does qualify. It's only the property that would have to approve after that. But it comes with a certified approval. Oh, I think we have a picture. Yes, it comes with a certified approval saying that this person is qualified.
So once we have that,
unlike a regular pre-approval, which is kind of unverified information, it's documents that we have in front of us, but not information that we've verified, because I don't know if you guys know, but our job is to verify. We verify things the first time, then we have a loan opener, assistant, a processor, an underwriter, and they all verify the file again for us. You know, it's many, many, many steps of verification, and this program allows us to do all that certifying up front, to not waste time while we're already under contract, and to not, because you never know what's going to come back on a verification of deposit, a verification of employment that could ruin your deal. So this certifies that we take care of all that up front, and it looks good for a seller. You know, they want to know that that client qualifies,
for sure, because
it's always a risk. You know, anybody that's pre-approved could always, knock on wood, it could always go south. So this certifies that 99% of the time it will not go south, especially from the buyer side. If it does, it's an appraisal issue, it's a property issue, it's not our client's fault.
Usually, unless they decide something happens and they decide not to work no more, and then they'll do that verification of employment, and we can't close because without income, there's nothing that was gonna certify.
There's always surprises. And you wouldn't believe it, but people are always getting cars the day before closing, quitting their job the day of closing. We don't need this job, and they don't understand. We verify up until the day of closing. Yes. We are calling, we are verifying, our team is calling and verifying. So this is just a little bit more security. You know, it's a security for the seller, knowing that we have done our due diligence, and hopefully nothing goes wrong.
So can we get those clients as leads, or we already bring them to you?
Yeah, you guys bring them to us. We
Okay.
don't.
I like that kind of answer.
Now, one thing that I do want to mention is that we don't have to hold our pre-approval letter because of this. We can still issue a pre-approval letter based on the information we gather, and then at the same time, we'll be working on getting the fast track done. And then once we get the fast track, you can still have it maybe because we haven't been able to get a house or property under contract at that time. And then you can put this with your DU findings and then the offer and stuff like that. So, and then of course we can always call the listing agent and explain that what that means. I think that helps a lot. It's a huge thing.
Next.
You want to touch on that one?
No. Go
Okay,
ahead.
okay. So this one actually goes tied with the fast track. So it's the 5,000 guaranteed, meaning that once we have that fast track approval, the approval from our licensed underwriter, and let's say we already have that and you go and look up properties with the buyer and then the buyer already likes one property and you want to put an offer, great, that's fantastic. You can send that property over to us. We'll take a look at all the taxes, if there's HOA and stuff like that. And we can actually, once we get the information and verify, we can actually have our branch manager get a $5,000 guarantee to the seller that in case something happens and we don't close, then the seller can get $5,000 reimbursed to them. And that's very catching for the seller. And the reason it's not like we're gonna give everybody $5,000, but the reason is because we have already done so much work that we don't see anything that is gonna go and fall through or make the deal not work. So we're putting that $5,000 so the seller can actually sign that offer and then we can go ahead and proceed. So that $5,000 guarantee is gonna really, 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 really help get that offer accepted, hopefully.
Yeah, it would be also like part of the pre-approval, like letting them know that this is the $5,000 guarantee so the seller can see that and be like, oh wow, so if we don't close in 21 days, our company, it's not that the buyer pays it, it's our company, they pay the $5,000 if we do not close in the 21 days. But we do need the property information as well as the fast track approval because although someone qualifies for like $300,000, it doesn't mean that every property for $300,000 they will qualify for. Everything is basically a monthly payments game, and you can have a property for $300,000 that they pay $2,500, and that's normal, or it can have an HOA of $400 and the client no longer qualifies. So we need the property information up front to make sure that the buyer's income can carry that mortgage. So that's why we need the property information up front, basically.
That's true.
And you can't give a $5,000 guarantee to like that Cash Plus because that's only 3.5.
Yeah, it's a different program
it's
type.
A different, yeah. So this one goes with the fast track, and then the Ribbon and Cash Plus is a different program. Remember, it's rolling to this county, and it's like kind of new. So once it comes here, we'll go ahead and tell you. But this is the one that will cover our county, Palm Beach and Miami and Broward. This one goes with the fast track, and Cash Plus is a different program. So either once Cash Plus gets here, either we use one or the other one.
I got a comment from the online says if the appraisal running the deals, the 5K is still on will given.
Yeah.
If the $5,000, they're asking if the $5,000 will be given to the seller in case the appraisal comes low. No, because we have to make sure that that property actually passes through. Let's say if it does come in low, and then the buyer and the seller agrees to make up the difference, or the seller actually matches the appraisal value, then yes. Yes, in that case, yes. I hope that answers the question.
Next.
Okay. So here we're gonna be now those are the type of programs that Crosscountry offers, the ones that we talk about, and this is the type of programs we're gonna be moving forward. This is the standard, many of you already know. FHA, conventional, VA. Those are like the main programs that we always want to put our buyers, just because of the terms, how low the down payment is and the interest rate and the down payment. They're very flexible, and that's usually what's the best for the buyer. That's not always the case, and then we'll talk about it later on with the other programs. On this one of the things that we wanted to mention is for self-employed borrowers, with the conventional, not VA and not FHA. If a borrower is self-employed for more than 5 years, we can do 1-year tax returns. If they have a credit score over 720, and then we'll do the run findings, and if the system actually approves it, we have closed files with only 1-year tax returns for self-employed borrowers. Again, not FHA and not VA. That only applies with conventional.
What if the buyer is a couple and one is self-employed and one is a W-2 employee?
Very, very good question. So they're asking me if we have a couple and one of them is W-2 and the other one is self-employed. We can still do 1-year tax returns for that self-employed. Let's say they're gonna be buying a primary home. We'll use the W-2 plus the pay stubs for that buyer who is W-2 employee, and then the tax return, 1-year tax returns for that self-employed, and that's how we're gonna calculate the income, only 1 year, not 2 years.
I think 2 pieces of, excuse me, 2 pieces of information that we just wanted you guys to know, something that's common for us, but we don't always think about what the buyer knows or what the agent knows. Something that you can keep in mind is that, like you see on the screen, under a 580 credit score, we're still able to do manual underwriting loans. They're a little bit more complicated, but something we can do, and one of the conditions will be to show alternative credit, which is 12 months of an FPL bill, a water bill, a cell phone bill. So that's something that even clients with not the best credit can still qualify. And then in addition, if a buyer has liabilities on their credit report, for example, this happens a lot, is why I bring it up. People have cars under their names that are not always theirs. So if someone else is making the payment on the car for 12 months and we can show that on the person's bank statement, not the buyer, but the other person's bank statement, that they have been making the payments consecutively, we can remove that car from the DTI. So that helps a lot, because a lot of people let people borrow their credit and stuff like that. So we're able to show with 12 months bank statements that that car does not belong to them, that payment doesn't belong to them. So that increases their pre-approval amount by a lot sometimes, by
Yes.
$700, $1,400 if you have 2 cars under your name. That makes the biggest difference. And I know a lot of you guys know how to calculate DTI. So that's why I wanted to let you guys know that there are ways that some things can be removed, not from the credit report, but from your client's liabilities.
That's true. And also I have clients also that also co-sign for, let's say, mom or on the house, co-sign on a mortgage for their mom, daughter, stuff like that. We can still do the same thing, which will be documenting that those parties are responsible for that mortgage, but only one person is the one making the payments, and they still can go and buy their primary property on the side.
She brought up a good point. It's not only cars, it's also with mortgages. Sometimes people co-sign on a mortgage and then they think they can't buy another property, but they can. If you can show that the other person has made the 12 months consecutive payments, then we do not have to count that liability against our borrower.
Yes.
And that helps a lot in a lot of cases.
Yes, yes. Very important also, a thing that I wanted to mention is that mortgage, not the mortgage statement, but the bank statement has to be under that, the other person's name. It cannot be the borrower. We're going to be qualifying. Okay.
Any other questions on FHA conventional VA?
Can we go back to the cash bus real quick? Would that be applicable to to buy a foreclosure or pre-foreclosure or bank.
That's something we forgot to touch on.
They need to buy it cash.
I don't think so. I don't think it, and we also forgot to mention, it doesn't work for most condos either. Condos are not usually that secure, so we wouldn't offer the cash plus. I don't think the $5,000 guarantee on a condo either, because they're very complicated to finance. It's just Fannie Mae and Freddie Mac, they don't always approve the HOAs. So it's things that are really out of our control. It's the association that doesn't qualify with Fannie Mae and Freddie Mac. So that makes it so when we purchase the loan, we cannot sell it to Fannie Mae or Freddie Mac. So a lot of the time, financing, I would always say for a condo, do 45 days. Don't do anything like this because condos have a bad reputation. I'm sorry.
And then regarding the property and stuff like that, another item that we need to make sure we mention is about the inspection. This program requires that there's an inspection done on the property, and the company itself is going to review that inspection and make sure that the property passes, meaning that there's no like a big damage to the property, because remember, in case that our buyer is unable to finance or secure financing, they're going to be holding that property, and they want to make sure that whoever the tenant or our buyer who is going to become the tenant, they're going to be able to live on that property and not asking for repairs. You know, it's a big company, they don't want to take that risk, so they do review that inspection report.
I would say mostly always for FHA and conventional, they have to be livable properties. They can't have broken windows, broken walls, which happens a lot in foreclosures. They have a lot of damages, and you usually can't finance things with damage. And then in different cases, they have to have the refrigerator, the oven, electrical has to be working, water has to be on. So foreclosures are usually a no-go for most financing options. Senor.
The Cash Plus and the Fast Track, are they qualified loans or non-qualified?
Qualified mortgage. Yeah, they're traditional.
Okay.
Yes. So the next one, this one is a non-qualified mortgage, which is a non-traditional loan. This is basically, this is the type of program that will use on those buyer that has over $1 million in the bank account, and then they not necessarily had to be working or document they're working. So what the investor will do, they'll use that liquid assets that they have, and they'll use that as form of securing the mortgage, or making sure that in case that they decide, or they don't have that income, or the income documentation that we're not going to have, they still have a lot of funds into their bank account where they can actually pay or make that mortgage payment.
Yeah, the reason that the traditional buyer wouldn't use this program is because they don't have $1 million in the bank account to cover the mortgage, the cash to close, and any like additional mortgages that they have. They have to have the money in cash. But it does work for a lot of people that are self-employed, that have $1 million of liquid assets in their account, and they don't have time to start showing all their taxes and their paperwork. They can use this type of program where it's just showing the verification of assets.
True. So this is just, again, going over different type of programs depending on your client. Each case, it's different and unique. Every client is unique. And then before we go to the next slides, this is where we have the down payment, and the requirements is if it's a purchase, you can go ahead and put 10% down, and it requires a 720 credit score.
And if it's an investment, 25% down.
25% down, yes. Okay. The next one is foreign national. We get a lot of questions regarding foreign national and the DSCR. I always get confused spelling it out. So foreign national are going to be for those clients that have or may not have a visa, a U.S. visa, and they want to buy a property here in the United States. Of course, it's going to be on the mortgage application. It has to be an investment property. It's not something that they're going to be living on, because we still have to say that they live in in a different property. They do require 20% down, 80% LTV, loan to value. In case that the client has the funds in, let's say, Peru, Colombia, in a different country, they can still, before closing, we have to verify that those funds have been transferred to an institution here in the United States. And any document must be translated. They do not require to have a credit score here. We do have to get, let's say they don't have a credit score, we do have to get letters from institutions in their country where it shows that the borrower is in a good standing with them, meaning that they have, let's say, if it's the debt that they have, it has to show that they have been paying that debt, how long it's been that they have that account. And regarding the income, remember, they work outside of the United States, so they might not have that tax returns. So in that case, again, we'll go with the letter from outside of the country, and everything needs to be translated. Everything needs to be translated. Mm-hmm. We do have a question here from the public.
You mentioned they have to have a visa or no?
They do not require.
It's not required?
No, it's not required. It's not required. The next one, which is the DSCR. So for that one, also it's an investment property. It can be, of course, U.S. citizen and a green card holder, but we're not going to be verifying the income on this one neither. But the property that they're going to be purchasing as an investment property, we have to make sure that the rental income offset the mortgage payment, and that with that, then we're gonna be okay.
Mm-hmm.
What does it stand for? I'm sorry,
Debt service coverage
Ratio, I think. No.
Ratio?
Rental. Let's see. I think
debt service coverage ratio, I think. Yes.
Does the money, do they have to transfer their deposit over to a U.S. bank and have it seasoned for a certain amount of time?
No. For the foreign national, they're asking me if they have to have the funds in the U.S. bank account for a certain period of time. No, they do not.
You just document the movement of the money from their country, their bank account, to the American one. As long as we can document everything, it should all add up and make sense.
Even if it was for like their primary property, you still wouldn't have to do that?
It's an investment. Remember, foreign national is a person that lives outside of the United States, and they're going to be purchasing a property here in the United States as an investment.
Gotcha.
And then the property that they have, we're not going to be able to finance as a primary residence. So,
The down payment.
20%, yes, 20%. And the interest rate, it's around 9%. It varies, daily and stuff like that.
It's a non-QM program, non-qualifying mortgage. So it's not a traditional program that we can sell to a regular investor. These are specific banks for this, and yeah, they charge 9% interest rate, 10%, and they have to put 20% down. The purpose of the DSCR, though, is for investors that they don't have tax returns and they don't have, we have another program that we'll speak about later, that's bank statement programs. And this is for investors that don't have either of those, because sometimes they don't put all their money in the bank, or they don't make consistent deposits every month, or they have several different bank accounts that they move money around in. So this is for that investor that cannot do a bank statement and cannot show their tax returns.
And
Just
closing
simpler.
cost ranges.
I will say it's standard. I will say 6% to 7%, 6% plus the down payment. Mm-hmm. This one is another one, non-QM, 18. Okay, this one is for clients that are here in the United States and they don't have a green card, or they're not a U.S. citizen and they do not have a work permit. but they do have ITIN. We actually got recently a investor that accept a 10% down, which is very, very low for ITIN. Usually it's more than 20%. They do require a credit score of 720 up. If it's less, they might require a bigger of a down payment. Of course, this one is not Visa, they don't have that. And then and right here it says that closing cost, which is usually what we talk about before, 6.5, 7, depending. That's the closing cost as well. Any questions on that?
What does it stand for?
ITIN is just ITIN is the document that you get from the IRS. It's like a social security number. It's like a social security number, but yes, for the buyer. You get it for
So it's their personal ITIN number. Just like we have a social security number, it's their ITIN number, yeah. So that's kind of what the number's called.
Will somebody have a credit score even though they don't have a social security?
Yes. They're asking me if a buyer with an ITIN number can have a credit score. Yes. So that's going to be like, it's like a social security number for the person. They can issue that for a person, for an individual, or they can issue it for a business. So they can build a credit score with this number, and then if they're during the process of getting a green card holder or work permit, once that transaction gets done with the lawyer or immigration, stuff like that, they can actually transfer the history from this ITIN, the credit history with the ITIN, to the actual social security number. So it is very good for clients to actually build credit with this. Oh. Next one, we do finance lots. We do have an investor that can actually do the financing for lots. Now they do require a down payment of 35%, and the loan amount we cannot finance, it cannot be less than 100,000. The credit score is 660 here, the minimum. Of course, the higher, and I always recommend the higher the credit score, the better it is. It just looks way better for the investor, for the interest rate, many things. Maximum term that we can finance on the lands or lots is going to be 20. Usually you see the 30 on a property, but for here, just the land is going to be 20. They do not have a prepayment penalty, which means that they can sell the lot way before the 20 years, and they don't have to pay a prepayment penalty. And the rates are fixed, they're not flexible, which is very, very good too, I believe. I believe so. I suggest people always trying to get
a fixed rate.
Yeah, fixed rate, depending on the client, but usually a lot of people are gonna maintain that mortgage for a long period of time, so I recommend the fixed rate. And there's different ways the investor can actually verify their income. They can verify the income based on the W-2s, and if not, they can do tax returns if they're self-employed. They can use bank statements. They can get a profit and loss from the CPA for this specific, when they're gonna purchase the lot. And they do the DTI, the maximum debt to income ratio, which is a calculation that the investors will do based on that income and the debts and the payment that they're going to be making on the mortgage is going to be up to 43.
And the rates of financing is the interest?
The interest rate, I would say 9%. Usually non-QM are 9, depending, 8.5, depending. Okay, the bank statements. The bank statements. This is a good program for those self-employed borrowers that
don't have taxes, don't have proper tax returns. They put a lot of deductions on their taxes, so they're not able to use their taxes for a purchase, but as long as they have consistent deposits, or we actually average out the 12 months or the 24 months, so they don't have to be consistent, but they have to be large enough as an average to carry the mortgage.
Yes, yes, yes. So you've seen those self-employed borrowers that decide to put a lot of deductions. Why? Because they're going to be paying less at the end of the year next year, and that helps them, lower the payment that they go have to send to the IRS. But when they come to us and they want to do a financing, that's not going to really help them. Mm-hmm. So they provide the bank statements, and then we'll have to go each line by each line and see how many deposits they make. Of course, the deposit cannot be cash, or it cannot be like a borrower have 2 accounts and they transfer the funds from one account and another account. That's not actually income delivered from their services or products or income that they have generated. So the underwriter is actually going to see which deposits are coming from a third-party company, or like a check made payable to them and stuff like that. And that's actually gonna be used as the income. They use usually like 50% of that deposit, and then they'll put that as the monthly income. Another thing to mention, it's not like, let's say, a buyer or the borrower is gonna be selling a house, and they did a large deposit because of the net proceeds. That's not gonna be counted as income. Has to be something that they get every month. On this one, the down payment on primary properties are 10% down, and then investment, it's going to be, of course, usually investments are higher than that. Yeah. Interest rates about the same, which is 8.5 and 9%.
8 to 10, yeah.
And then the closing costs are usually 6.5 and stuff like that. But it's a really, really good program. I use that a lot now. Very good. I try to use it. I was going back and forth with the investor, and on this one I was not able to do it with a client that had a work permit. So it's for citizen, U.S. citizen, and green card holders. That's very big to mention. I think that helps a lot.
Yeah. I think you covered everything.
I think.
Just like she mentioned, transfers from other accounts can't be used as deposits, sales of vehicles, of homes, unless you're a property flipper and that's your occupation. Then you can use the proceeds from a home. That would be your income.
Yeah, so we have another question.
With this type of loans, I mean, the interest for a primary home is really high to sustain mortgage payments. Is there a chance eventually to refinance to a more easier interest rate?
Yes, and so we have a question regarding if we can refinance, because non-QMs do have an interest rate higher than standard FHA and VA conventional. Yes, we do. We actually can refinance. There's not going to be a prepayment penalty on primary properties. If it's an investment property, it does have a prepayment penalty. And the only requirement that the investor will have is that they have to be, and that's in general, in every single loan, they do have to be making the mortgage payment for at least 6 months after closing. But then after that, you can go ahead and refinance and no issue at all.
And how long can they refinance?
After 6 months of making mortgage payment. So at the 7th month of making your mortgage payment, you can go ahead and refinance. Okay, so in less than a year. Okay.
And it's 30 years, right?
Yes, we actually have a 30 and 40 year, and then also on this one, you have an interest payment only. So you can only be paying interest and not the principal.
But this one that's available, like an interest only is available as well as principal and interest.
Yes.
So it's available for some people who see themselves selling the property within a year. They just do interest only payments, and that helps them save a lot of money in that way.
Will this loan facilitate for flip as well, or?
No, this is.
There are better options for that?
Yes, not for flipping. Usually, many of our investors will look at the property and make sure that the properties, you can live on that property. Like there's not like big repairs.
I think that's. I guess we're ready for questions. I guess.
Any other questions?
You got them all?
No. You mentioned that there's a program that now can finance 40 years.
Mm-hmm.
Which ones are those?
The bank statement.
Bank statement loans, not
Yes.
conventional or FHA?
No. That's only the new non-QM, and it's gonna be the bank statement program, and they'll do 10-year principal, and then the remaining is gonna be principal and interest. Well, thank
10-year
you.
only principal.
What is it?
10 years, the first 10 years
Yes,
only principal?
the 10 years is gonna be principal, and then the remaining 30 years is gonna be principal and interest. Well, thank you everybody for joining us here and over there at your houses. And if you have any questions, reach us out. Here are our contact information. Thank you so much again, and we hope to see everybody soon.
Thank you,
Bye.
guys.